Welcome to today's Explainer. We're breaking down CIBC's third quarter 2026 investor briefing. And honestly, we're going to be untangling a really fascinating tug of war today. If you've been watching the Canadian banking sector, you know it's been a wild year. But this specific earnings report, it perfectly highlights the massive tension between a seriously high-performing company and a stock that is suddenly looking historically expensive.
So let's just dive right into the central paradox of this whole report. CIBC absolutely crushed expectations on almost every single operating metric you can think of. They delivered the kind of massive growth that makes headlines. But if you look at the consensus rating from Bay Street Analyst right now, it's sitting at a very cautious hold. You have to ask yourself, if earnings are up 26%, why aren't analysts screaming buy? Why would a bank delivering double-digit growth not be an immediate, aggressive buy recommendation? Well, that's exactly the puzzle we're going to solve today.
To do that, we're going to unpack this briefing across 4 quick areas. We'll start by dissecting the big beat, then look at their 3 main engines of growth, do a quick valuation reality check, and finally lay out the exact investor playbook.
All right, part 1, dissecting the big beat. Let's get right to the headline numbers that had the entire market buzzing this morning. The bottom line here is, frankly, massive. Adjusted net income hit roughly $2.6 billion for the quarter. That's up from about $2.1 billion a year ago, which means we're looking at a 26% increase year over year. To put that into perspective for a second, in a mature, established sector like Canadian banking, generating that kind of top-tier growth absolutely cements CIBC's position as a premier, growth-oriented player among the Big Six. Oh, and revenues? They perfectly met expectations, coming in at $8 billion, which is a very healthy 15% jump from last year.
And this beat was literally across the board. Take a look at adjusted earnings per share. It came in at $2.73. That completely smashed the $2.52 consensus estimate analysts had modeled. As CEO Harry Culham was quick to point out in the briefing, this is the bank's 9th consecutive quarter of double-digit EPS growth. 9 quarters! That is a track record that forces investors to pay attention. It proves this wasn't just a one-off lucky quarter. It's a sustained trajectory of real high performance. Now, you might be wondering why we keep saying adjusted earnings. Well, if you look at the raw, unadjusted data, reported EPS actually came in slightly lower at $2.47, which technically missed consensus. But you always have to look under the hood. That lower reported number was entirely driven by a non-recurring $269 million pre-tax charge tied to the sale of their Caribbean operations. Institutional money managers, they just strip that one-time noise right out so they can see the real underlying operating performance. And that underlying engine is exactly what drove the massive $2.73 beat. Then there's the defensive side of things, specifically provisions for credit losses, or PCLs. These came in at $564 million, significantly below the street's rather fear-driven forecast of $629 million. What you should really take away from this is that despite all the broader economic headwinds and a slowing Canadian economy, CIBC's credit quality is holding up remarkably well. They just aren't needing to stash away as much cash for bad loans as the market assumed they would.
Moving on to part 2, the 3 engines of growth. So how exactly did they pull off this $2.6 billion across their operations?
The secret sauce here is pure diversification. The strength wasn't just hiding in one corner of the bank. It was incredibly broad-based. You've got their Canadian banking operations pulling in $948 million, a surprisingly powerful capital markets division hitting $722 million, and a rapidly growing U.S. commercial and wealth presence generating $320 million. Let's zoom in on these. Engine number 1 is Canadian personal and business banking. This is the traditional workhorse of the bank, and right now, it is firing on all cylinders, with net income jumping 17%. What's powering that? Well, loan growth was solid, for sure, and they successfully widened their net interest margin to 3.04%. But here's the part that gets me really excited for their long-term growth. Their digital strategy is crushing it. They added 4% more high-value mass affluent clients and saw an absolutely incredible 34% surge in new digital accounts for their Investors Edge platform. They are genuinely winning the battle for higher-value customers through digital innovation. But hey, they're proving to be way more than just a domestic retail bank. Engine 2, capital markets,
totally stole the show this quarter. Net income there jumped 34%, fueled by a massive 40% spike in trading revenue plus higher investment banking fees. This division has basically evolved from a background support function into a massive growth driver. And then you have Engine 3, the U.S. commercial and wealth segment. This added some real geographic diversification with a 23% earnings bump, riding the wave of higher interest rates and increased cross-border activity. Which brings us to part 3, the valuation reality check. Is the market already pricing in absolute perfection? One Bay Street analyst hit the nail on the head in the briefing, saying the stock price may now need to wait for earnings to catch up. That perfectly captures the vibe right now. Yes, the fundamentals are rock solid. Yes, the growth is incredibly broad-based. But we can't ignore that the stock has already run up significantly this year. The market has basically already priced in a ton of this good news. So the stock price might just need to take a breather and let actual earnings catch up to the premium it's trading at.
It's a classic tug of war. On one side, you have undeniably phenomenal news. We're talking a 16.8% return on equity and a massive CET1 Capital Ratio, which is essentially their core financial safety net of 13.4%. They have so much excess capital that they repurchased 7.5 million shares this quarter alone. But on the flip side, the price tag isn't cheap anymore. The stock is currently trading at 14.4 times forward earnings. When you compare that to its long-term historical average of just 11.3 times, it makes sense why the consensus is a hold, with a target of around $165 Canadian. There's definitely upside left, but those massive 20 to 30% pops we've seen recently, those are probably in the rearview mirror from now.
And, institutional money is also sweating the macro risks. We've got ongoing trade tensions between Canada and the U.S., which are always a wild card. There's lingering geopolitical uncertainty that could easily spike volatility and cool down that high-flying capital markets division. And perhaps the biggest dark cloud? An uneven, slowing Canadian economy. If domestic growth stalls, that could seriously pressure consumer lending and force those credit provisions, which were so incredibly low this quarter, right back up. All right, part 4, the investor playbook. Let's translate all these numbers and metrics into an actual actionable strategy. So, what's the move? Well, if you already own it, the playbook says to simply maintain your position. You get to sit back, enjoy a very safe, incredibly well-covered dividend, and let this growth-oriented bank do its thing. Just don't chase it by adding more at these elevated levels. But if you're a new investor on the outside looking in, the recommendation is patience. Because it's fairly valued right now, you aren't going to get multiple expansion. Your upside is totally reliant on earnings growth. So take a partial entry, keep some dry powder ready, and wait for a 5 to 8% pullback before you really back up the truck. To see if we actually get that future upside, analysts are laser-focused on a few upcoming catalysts. In the short term, everyone is watching the Bank of Canada. Any further interest rate cuts could seriously juice mortgage and loan demand. Midterm, any kind of positive resolution to U.S.-Canada trade spats would be a huge tailwind. And finally, all eyes are on November 2026 for that Q4 earnings drop. That's when we'll really see if this loan growth and margin stability can hold the line. Look, the numbers today were undeniably stellar. It was a masterclass in diversified growth. But as we look ahead to Q4, here's the real billion-dollar question. Can CIBC's incredible multi-engine machine continue to outrun the macroeconomic gravity of a slowing economy, or has the stock price finally flown just a little too close to the sun? It's going to be fascinating to watch. Thanks for tuning in to this explainer, and we'll see you next time as we keep breaking down the numbers moving the markets.